Good morning, everyone, and welcome to today's first quarter call focused on three of Barron funds: the Barron Global Fifth Avenue Fund, the Barron Global Advantage Fund, the Barron Fifth Avenue Growth Fund, and Barron Durable Advantage Fund. I'm happy to report that all three of these funds had a good quarter and beat their primary benchmarks. The two funds that focus primarily in large-sized U.S. companies, the Barron Fifth Avenue Growth Fund was up 19.67%, versus 14.37% for the Russell 1000 index. The Durable Advantage Fund was up 16.04% versus 7.5% for the S&P 500, and Global Advantage was up 9.41% versus 7.3% for the MSCI ACWI index. Global Advantage is the largest of these three funds and just celebrated its 11th year anniversary this past April, and has an average annual return on its institutional shares since inception in 2012 of 9.92, which outpaces both its benchmark and its Morningstar global category average. It's my pleasure this morning to introduce Alex Umansky, portfolio manager of all three funds, and Guy Tartakovsky, assistant portfolio manager who works alongside Alex. Good morning, Alex and Guy.
Morning, Frank. Good morning, everyone.
My name is Frank Majorano, and I am the Vice President and Head of the Registered Investment Advisor and Family Office business at Barron Capital. Before we get started, I just want to encourage you to submit questions anytime during today's call by emailing questions@barronfunds.com. That's questions@barronfunds.com. And to visit our website, barronfunds.com, also to review Alex's quarterly letters on all three funds. So Alex, to get things started, since you manage three unique funds, can you explain the difference between the three funds and perhaps maybe offer a little context and shed some light on why their performance had such a wide range of outcomes during the first quarter?
Sure. Thank you, Frank, and welcome everyone to the call. So the three funds that Guy and I manage are fairly different and distinct. Global Advantage has the broadest mandate and the largest investable universe. We think of it as unconstrained equity. Frank, can I ask you to go on mute, please? I get a lot of feedback. So Global Advantage is really designed to be best ideas anywhere in the world. Over time, Frank mentioned we just celebrated our 11th year anniversary. Over time, we made it the best big ideas anywhere in the world. Fifth Avenue Growth is really a subsection of that. It is focused on US large cap, which is, say typically about 80% of the fund. And then the other 20% is invested in large cap names that are outside of US, but still high growth, still very high optionality, platform type businesses with network effects and very large end games. Durable Advantage is very different. It is designed for post high growth businesses, high current free cash flow generation, and a return of excess capital back to shareholders in the form of either dividends or share buybacks. It is exclusively large cap and is meant to have lower volatility and is benchmarked against S&P 500, which is really a core benchmark, as opposed to the other two funds, which also measure themselves up against the growth benchmarks. So the biggest difference in performance in the first quarter, as Frank mentioned, they were all up. Global was up 9.4, Durable up over 16, and Fifth Avenue up almost 20. The biggest difference in our view is really related to market caps. Josh Saltman, our fintech portfolio manager, mentioned to me just yesterday that 84% of the first quarter's gains were attributable to just 7 mega caps: Microsoft, Amazon, Apple, Google, Meta, Nvidia, and Tesla. So the 7 stocks were responsible for 84% of total absolute gains. Now, the good news is that we own at least some of them in all of the three funds, although we did not own all of them, or let's say enough of them in any of the three. Global Advantage at this point has really become a SMID cap fund. We never owned Microsoft there at all. We sold our shares of Apple in like 17 or 18. We sold Meta at the end of 2021, just before it collapsed and lost over 60% of its value. And finally, we sold Google and Amazon at the end of last year. So NVIDIA and Tesla were really the only two mega caps that we still owned in global. And then, of course, almost half of the fund is invested outside of the US, which also did not do nearly as well. So a 9.4% gain in that context and in that environment, was really not bad at all from our perspective. Now, Amazon is still the largest holding in Fifth Avenue and has been since 2014. But NVIDIA now is the second largest holding in Fifth Avenue, and then Meta was around 5%, and Tesla was in the top 10. And so it was kind of the right time, right place. The environment was favorable, and that's how we had a 20% pop. Now, I think durable was actually even more interesting because with the exception of Apple and Tesla, we had them all. Microsoft, Meta, and Amazon were the three top holdings in the fund, and NVIDIA and Google were not far behind. We actually ended up trimming some NVIDIA during the first quarter since we're more valuations that were not sensitive, probably more valuation constrained, I would say, in durable and more volatility mindful. But anyway, I think market cap really was the biggest factor as to why we see the performance divergence in the first quarter.
All right, perfect. Thank you for that, Alex. In the past calls, we haven't focused quite as much on durable advantage. So can you tell us why it's done? You alluded a little bit to it just then, but a little bit why it's done better than the other funds most recently, or why it's done so good recently, and also better than, because it's a growth fund. Do you still consider it a growth fund? What makes it unique, and maybe how might you look at it when you consider like how an investor might use it in their overall portfolio?
Sure. Well, the fund is focused on more mature businesses. And when you have an environment like last year, when high growth stocks are severely out of favor, this fund will certainly hold up better. It is definitely a growth fund, and it is definitely, competitive advantage and well-managed businesses over conventional value-based theses, or I guess thesi. But present free cash flow, or I guess we should say current free cash flow yield, is a must in the durable advantage fund. We're not hunting for big ideas there. Now, could Amazon and Microsoft and most certainly NVIDIA turn out to be big ideas from here? Absolutely, but it is not a requirement in order to make the investment like it is for Global Advantage or Fifth Avenue. So holding up better in the down market kind of was expected, and I guess we can say was achieved. The other part of it, Frank, is, how I always talk about how everything is cyclical. Markets have cycles, growth is cyclical, even structural growth driven by disruptive change and innovation also has cycles. I often say human beings are very susceptible to cycles. We all go through periods of time when we're patient and measured and well-tempered and kind of gracious. And that's when we tend to make good decisions. And then there are periods of time when it's the opposite. We're stressed, we're angry, we're upset, and nothing we do seems to be working. We had globalization, let's call it, for 30 years of post-Cold War peace and prosperity and rising standards of living and emerging middle class with higher disposable incomes and all of those good things. And then we got the global pandemic, a war in Europe, global tensions, and it really does not seem like anyone right now is capable of making good decisions. So I think mutual funds also have cycles. And so durable advantage is now just entering the virtuous part of its life cycle. Success begets success because it was going down a lot less last year. It suddenly started to attract fresh capital. The fund took in just about $15 million net in the fourth quarter alone of last year. Now, it's not a ton of money, but it's not insignificant in the context of the size of this fund. And so the inflows that we took were used to buy Meta, Microsoft, and NVIDIA. Those were the three largest additions at the end of 2022. And, as luck or timing would have it, Meta went up 76% in the first quarter, NVIDIA was up over 90%, and suddenly Durable pops up in the Wall Street Journal's Category Kings as the third best large cap growth fund over the last 12 months as of March 31st. Apparently it was down just 2.7% over the last 12 months, which is pretty impressive given what happened in the growth space. And so, we've been kind of taking money ever since. We've had inflows into Durable every month this year. And it's an enormous advantage to be able to attract inflows in a down market or during very volatile markets, which really doesn't happen very often. Typically, investors tend to chase the markets up and kind of run away in times of high uncertainty and doubt. And so, we think Durable Advantage is really pretty well positioned right now in terms of the virtuous part of its own life cycle.
Thanks for the clarity on that one, Alex. Yeah, I think it's a little bit of a hidden gem. I look at inception, 3 and 5 years. The fund has performed quite well. So congratulations on that. So let's use this opportunity to dovetail a little bit into Global Advantage and Fifth Avenue. In past letters and a lot of things you write and talked about, you talk about just that you guys are disruptive change investors. Most recently, you've highlighted the rate of disruption is really accelerating pretty quick. So when you think about disruption, what's the biggest disruption you're seeing today, and how do you position your funds to both benefit from the disruption, and how do you position your funds to avoid companies that might be left behind a little bit?
Sure. So we do talk about disruptive change a lot. We believe that every investment, that the disruptive change is so pervasive this day and that it is accelerating, that every investment must be evaluated through this disruptive change lens. I think majority of our fourth quarter letter was spent discussing artificial intelligence and how disruptive AI is becoming and how it may be hitting an inflection point. So we had 2 mega caps report earnings just last night. Of course, it was Alphabet and Microsoft. Microsoft mentioned AI 65 times in a 1-hour-long conference call. Not to be outdone, Google mentioned AI 80 times. That's 80. And Meta is reporting today, and I think the over-under is now 80, and I would go above 80 on how many times Zuckerberg is going to say AI later tonight. I actually think this is a good opportunity to turn it over to Guy, who has spent a lot of time both researching this thing and kind of beating the drum roll of how important AI is becoming and how we need to make changes in the portfolio and really take advantage of this. So maybe Guy, take it over from here.
Thanks, Alex. What I would start is perhaps to kind of present our current view on AI. And AI has really become, pretty pervasive and potentially has some profound implications on the business world and on economies, we think, worldwide. So AI has been around for some time, and we have seen it power, from recommendation engines, right? When you go on Amazon and, you get products being recommended to you, or, it's at the basis of TikTok, for example, right? How they decide which videos to show you next. So it's been around for some time, recommendation engines, image recognition, autonomous driving and the developments there. But more recently, we have seen a pretty significant acceleration in the development with what's called LLMs, or large language models. And that has really started in 2017, when Google came out with a famous academic paper on transformer models. Now, these models, what they enable is the AI engine to basically start understanding context in languages. And the reason why it's important is you can have much more in-depth conversations with the AI agent. It has a longer-term memory, and it can keep context in mind, so you can ask follow-up questions, as you go kind of deeper and you try to have a discussion with it like you would with a real person. What we have seen recently is ChatGPT, obviously, that probably everyone has heard about. Amazingly, it reached 1 million people in 5 days and reached 100 million users in 2 months. Just to frame it, it took TikTok nine months to reach 100 million people. It took Instagram 2.5 years. The third point I would say, kind of the big picture point on AI, is that the pace of innovation has seen significant acceleration. Over the last 2 years, the innovation or the performance of AI, especially transformer models or these large language models, has seen a 275x improvement. So, and kind of if you're following Twitter and kind of the developments in ChatGPT and, most recently AutoGPT, you are seeing it in real time. We are seeing weekly, announcements from all of these companies. Heard Microsoft yesterday describe, very significant growth in their numbers as well, is driven by that. The last kind of topic on that is kind of what are the implications that we are seeing that are broader for us as investors. And we think it relates to, I'll call it 5 broad points. Point number 1 is a productivity boost, which is from, helping developers code to content creation, helping marketing teams come up with personalized content. And that will be pretty broad-based, and we think it's very early days there. Number 2 is we think it increases the importance of digitization. So companies that are not digital, that are not able to take advantage of their data, which is really the key ingredient for AI, because you train AI models on data, will be left behind. That means that every company will have to consider and will have to prioritize digital transformation. And we have, a fair amount of investments in companies that help others do that. Think of a company like Endava or, or EPAM or Accenture in Durable Advantage. Number 3 is that we think that the value of proprietary data will increase. So, again, it's very early days, but when we think about what will happen to competitive advantages, a company that has an ability to generate unique data will have an ability to train models that will enable it to get unique perspective and unique insights. So if you have a proprietary data or a business model that helps you generate proprietary data, you can jumpstart what we call, a virtuous AI cycle. And we talk a lot, more about it in the quarterly letter. But essentially, what we mean by a virtuous AI cycle is that if a company has an ability to generate data and then use that data to train AI models that create an improvement in its product quality, then the improved product will attract more customers, which will in turn contribute more data, and the cycle returns, right? You have more customers, more data, better model, better product quality, more customers, etc. The last point is that the value of platform businesses, in our view, is increasing. And that means that the opportunity for market share to be higher over the long term for the platform businesses is higher. And again, that is because these companies, in our view, will be able to get more customers, will be able to get more data, will be able to offer better solutions. One example is a company like CrowdStrike, where it's a cybersecurity platform, and the more the more data they get, the better, the better their ability to catch the bad guys, catch the hackers. And the better they are at catching hackers, the more customers they can get. So we have several investments, in AI, and I'll end here. NVIDIA that Alex mentioned is perhaps the biggest one. It is the picks and shovels to AI. They build the GPUs that everyone used to run AI models on. Other companies are companies like Snowflake, which is a data platform, and will be used by companies to kind of break down data silos and create these data repositories on which they can then train AI. And others are the leading platforms in their domains, like CrowdStrike or Datadog. And the last bucket I would call are the digital enablers, right? Companies like Endava and EPAM and and Accenture and Globant. But I'll stop here and see if Alex has anything else he wants to add.
Alex, anything on how you're positioning yourself to avoid any companies that are going to be left behind?
Sure. So in our view, legacy businesses that are either unable or unwilling to invest meaningful amounts of money into digitally transforming their businesses will be left behind. So we spend a lot of time asking our companies, how much money they are currently spending on digital transformation. And majority of our companies are telling us that, migration to the cloud, changing interfaces, investing in business intelligence, that this is a high priority for them. But whenever we conclude that they're either unable or unwilling, probably the other way, unwilling and unable, those are the companies that we try to stay away from. Legacy financials would be, a really good example. As I said.
All right, perfect, thanks. So maybe let's move up to the current environment a little bit. There's obviously a lot of volatility in the market. And I just was curious, like, how do you manage the volatility, and maybe talk about that a little bit in the context of some of the specific contributors and detractors. Some investors have been asking about several of your companies. We had a particular question about the outlook for Endava, and I always have to ask the controversial and ever popular question on your thoughts on Tesla.
Sure, Frank. So we believe that investing environment continues to be very tricky. I am unable to really distinguish what's changed in the first quarter from the fourth quarter. There's been really no change in the status of COVID. There's been no change in the status of the war in Europe, tensions with China. We can argue that we're closer to the end of the Fed's tightening cycle, right? But inflation is still running high. The Fed is still tightening. And yet in the fourth quarter, the market was down a bunch. And in the first quarter, the market was up. In the fourth quarter, we heard from our companies that they're very cautious. When they reported their results, they took guidance down, and their stocks went down. In the first quarter, I mean, it's early, right? But we're pretty much seeing the same thing. Neither Microsoft nor Google reported, exciting growth, right? Google said they're going to spend $70 billion buying back stock. But that's pretty much it. Although I guess Microsoft's numbers were more impressive, if we're being honest. Although I'm skeptical that PC is going to be a growth opportunity for Microsoft. I think that's a little bit of a joke, but we'll take 28% cloud growth. That's certainly, very good. The point is, it's very difficult to understand what is priced in, what investors' expectations are. The predictions were doom and gloom going into the first quarter. Every investor we spoke to, both buy side, sell side, financial advisors were kind of scared, right? And telling us that they're very nervous. They're not allocating money to equities. They're certainly not allocating any money to growth equities. No capital is coming in, right? And yet we saw, pretty healthy bounce back in the first quarter. We're still in this upside down, bizarre world where, good news is bad news and bad news is good news, right? And when economic data is good, the market sells off. It means that we haven't gotten enough of the medicine and the Fed's likely going to continue to tighten. And then on the other hand, when we get bad news, like the banking crisis, which was a really good example, right? Market went down for a couple of days, and then all of a sudden we had a big rally because the conclusion is that the banking crisis will serve as a hike. Some people estimated about 100 basis points worth of liquidity, would be coming out because of it. And so, suddenly the market went up. So my advice or my view is you really have to be careful in making any significant changes, and you have to be patient, and you have to have a lot of conviction in the names that you own. And in the short term, they're going to continue to really be at the mercy of macro. So you mentioned Endava. Endava is a great example. When the banking crisis hit, obviously it was Silicon Valley Bank that was followed by Signature Bank, and then it was Credit Suisse, and we can probably put First Republic into that category. We had zero exposure to those names. We had no investments in those names. None of our companies had any meaningful, amounts of money or anything, with these banks, or even any meaningful revenues with these banks. And yet, within a couple of days, Endava was down 20%. The stock of Endava got hit really hard as a result. And the reason is that financial services is the largest vertical for the company's business. Approximately half of their revenues come from financial services. Now, financial services doesn't mean banks, right? Banks are actually 10%, and I think regional banks were 2% of Endava's business. And, when we talked to the company, and we talked to them that Monday, their answer was, look, we don't know. We haven't heard anything yet, but is it inconceivable that the JP Morgans of the world, or even, the fintech companies of the world, will now postpone their projects, right? Could something get pushed out or delayed? It could. Is our confidence impacted? Confidence in the short-term results impacted by this banking crisis? Of course it is. Right? And so the question then becomes, so what do we do? Our stocks are getting hit. And of course, we own EPAM, and we own Endava, and lots of other, even the names that Guy mentioned, Snowflakes, CrowdStrike, financial sector is a very large part of the economy. And if that sector is going to be under pressure, right, they may temporarily reprioritize their spending. Is it a thesis changer for us? Is it enough for us to lose confidence in this long-term digital transformation trend, or the AI paradigm shift? No, it isn't. And so it's unfortunate, but we don't think it changes anything, and we are highly confident that this change in the price of the shares is short-term and will not result in a permanent loss of capital. The intrinsic value of Endava hasn't changed, even though its stock price went down, 20% just in those 3 or 4 days. And it's going to probably continue to languish until the company reports and basically either resets expectations or, confirms that they're not seeing any significant impact. And so, the last thing I want to do is kind of remind people that we do not position our funds for any particular environment. We had no idea that large cap or mega cap was going to dominate, in the first quarter, right? We have no idea if the Fed funds is going to stop at, 5%, or is it going to go 5.5%. Our goal is to invest in as I call them, a collection of 30 to 50 names, right, with certain characteristics that we believe will give investors the best possible risk reward over the long term. We are long-term investors. We have a long-term ownership mindset. And that's what guides all of the decisions that we make. Last thing on Tesla, there's really no change in Tesla. Tesla is taking a different, I think, approach given the high inflationary environment. Elon correctly pointed out that every time the Fed raises rates, it is equivalent to a price hike on his car. Overwhelming majority of car buyers are financing their purchases. No one's taking out $80,000 or even $50,000 to spend on the car. People either lease them or they finance it, right? And when the rates go from 4% to 5% or 5% to 7%, it is equivalent to a price hike because the monthly payment goes from $800 a month to $1,000 a month. And so Elon has a choice because Tesla is the single most profitable company in the industry. They've decided that they make the most money per car. They also have the lowest cost structure. So Elon decided that this is the right time to go for market share. That it makes total sense to make less money per car today, and in the meantime, see what Toyotas and VWs and Renaults of the world will do. Because we don't think they can compete on price at all. They barely making any money as is. So they would either have to lose money or cede market share. So we think the strategy is the correct one. Of course, it resulted in multiple downgrades, and the stock is, has sold off meaningfully. But we're pretty confident that the strategy is the right one, and we believe that Tesla's ability to eventually sell auxiliary services into their installed base, things like self-driving and other things, will enable them to have significantly better margins and significantly better monetization, once it becomes kind of clear that, the electric autonomous mobility is really their place.
All right, thanks for that. A question came in, Alex, and I think you answered a little bit when you talked about Endava, because it's an example, obviously, where earnings, revenue, bookings, everything's kind of looking good for the quarter, but the stock was down. So the question came in, do you lose confidence in companies after their performance languishes for a year, and how do you maintain confidence?
It's really a good question, Frank. On one hand, the price of the stock is really the tail of the dog, right? And you never want the tail leading the head, right? The stock price over any short period of time, and we would quantify 12 months as a short period of time, isn't always reflective, or sometimes not reflective at all, of the intrinsic value of the business, right? On the other hand, if the market is telling you one thing and you have a contrarian view, then you kind of have to ask yourself, what are you missing, right? Do you understand the sources of mispricing? Do you understand why the market believes that the world is one way and you think it is another? And so we actually address part of it in this quarterly's letter in terms of saying that buy and hold really doesn't work anymore. That we probably spend a decade and a half thinking that buy and hold is really the only right way to approach this. Now it's really buy, hold, and verify. And so we're increasing our efforts in seeking disconfirming evidence, right? So we talk about behavioral finance a lot. We think confirmation bias is a real risk. We think we're all susceptible to confirmation bias, where when somebody says something that really makes sense to us and confirms with our own views, we think they're smart, right? And we kind of nod our heads and like, this has validated everything that we believed originally. So it's easy to kind of fall into that trap. When the stock languishes and our thesis seems to be in question, we redouble our effort in talking not to customers of our companies, but let's say to customers of our competitors, right? I've spent more time trying to find short reports than I have, reading the reports of strong buy initiations, right? Whenever somebody downgrades the stock, this is the information that we need to get, kind of quickly and try to understand what is the thesis and what are we missing and things like that. So, there's no simple answer, I guess. I'm not going to say that just because the stock is not working that we're going to, give up on it or trim it or, but also please recall that we normally do not buy weakness, nor do we sell strength. And that means that if the stock is languishing, it will naturally become smaller weight in the portfolio. Right. And unless we understand, exactly what's going on and we have confidence that the market has it wrong, we're not going to increase a weighting in that investment.
Perfect. Thanks. Maybe as a way to wrap up, we had a question come in, and I know you talked about the differences in the different funds that you have, but also the different markets being US and global. Question came in, maybe just a quick outlook for Global Advantage over the next year or so.
I don't really know how to give an outlook for a fund. I can't give an outlook in the market because I really don't have one. There's no question that Global Advantage is, so what's the word? So there's a virtuous part of the cycle and there's a vicious part of the cycle. There's no question that Global Advantage went through the vicious part of its cycle, right? We had the virtuous part probably in, 18 and 19. I think that's where Durable is now, right? We took a lot of money in 2020. We ripped a lot of accolades. We were the best fund for trailing 3 years and 5 years for a number of years, and everything kind of was hunky-dory, right? And so a lot of money came in, and unfortunately, many of those investors did not reap the benefits of the strong performance in 18 and 19, and right, and they came in, either at the top or close to the top. And then 2021 was disappointing, and 2022 was a disaster. And so, majority of investors, even the ones that, remained, I don't know if loyal is a good word, but retained their conviction in, the stocks, the process, or Guy and I as the stewards of their capital, everyone's waiting to see when can we turn it around. So when I talk to, let's say, Frank, to your clients, they're telling me they have a lot of money that they want to put in, but they want to see one really good quarter. They want to see us recapture some of the past glory, right? They want to see us kind of knock the ball out of the, out of the stadium, for lack of better compare. And for now, we've struggled to do that. I mean, I have no idea when it'll come, but we certainly haven't lost any conviction in the names that we own, right? Now, Durable is better off because when money comes in, we can buy the NVIDIAs and we can buy the Teslas and we can buy, we can buy the dislocations, right? And when money is going out, it's a challenge. But I don't think Global is unique in this way at all. I think other high growth, highly successful strategies that were similarly struggling, last year are going through the same thing, and it's part of the natural cycle. And just like everything else, these cycles turn, right? They change. So, I have most of my money invested in Global, never sold a share, haven't lost conviction. And, I really do believe that when we look back at this period of time, whether it's, 2, 3, 5 years from now, this will prove to be a buying opportunity more than anything else. And the confidence comes from two things. A, because we know every name that's in there, every company, every investment, we understand the quality, we understand the opportunity, we really think they're big ideas, right? So it's a matter of time. And B, just there's no historical precedence of a massive bear market and a massive correction like this that has not proven to be a real buying opportunity, sometime in the future.
Alex, perhaps I can add a couple of
Please,
points.
please.
So if we look at what happened in 2022, across Global Advantage, the multiple contraction was, pretty severe. The multiple went down 57% in 2022. Now, when we look at our expectations for the fundamentals of the companies that we hold, either it's EPS or free cash flow per share, or EBITDA, or sales, depending on the company and how mature they are in their unit economics cycle. That is expected, to grow over the next 5 years at, let's call it low 20s% across the portfolio. Meaning that if multiples remain kind of stable from where they are today, this is what our expectations is for the portfolio as a whole. If multiples obviously come down as companies' growth decelerate, or as they become more mature, then that can come down, and if multiples correct, then that can go up. Now, at the end of the day, what we really are focused on is what drives the company's intrinsic values, right? And there are only a few factors that do that, right? At the end of the day, right? It's how big is the opportunity, and how how innovative is this company and able to solve more problems for their customers to take advantage of the opportunity, which will then imply what market share can they get over time. Number two is how economically profitable is this going to be over time and in maturity, or the entire discussion about unit economics. And the last two factors are the cost of capital, and by the way, in the first quarter, if you look at the 10-year and or even kind of the real interest rates, they have been coming down, not up. I think the 10-year is down from 3.9 at the end of 22 to around 3 and 3.4 now, and the 10-year tips are down from 1.6 to around 1.2, 1.3. And the last factor is the terminal growth rate. Now, of course, in the near term, and we are hearing it from companies, there will be pressure on businesses, right? And 2023 is murky, right? Companies are delaying spend, and budgets are pressured, and there are more areas where you need to go to the CFO to get a budget for an expenditure. So we will have some pressure. But if you look historically, times of stress tend to be also times when platform businesses gain market share, because customers tend to consolidate their spend on their most important vendors. And then when you marry that with kind of the AI revolution and the importance of being that platform and your ability to gain market share, we actually think that there is a potential that the current crisis will sow the seeds for winner take most dynamics, and will enable platforms to be to have higher market share over the long term, which will benefit their intrinsic values. So we don't think it's all so that's kind of the picture in terms of outlook. It's very hard to say kind of when stocks will bottom, and kind of the first quarter is a great microcosmos of that, right? When people thought one thing, we actually saw the exact opposite in the market, like Alex mentioned. But over the long term, over the next 5 and 10 years, we have more, not less, conviction in our companies.
Thank you for that. I think that's a good, optimistic, long-term way to end the call, which is very traditional for Baron. So this concludes today's call. Sure,
Frank, I apologize. Can I interrupt? I see one more. My good friend Jimmy sent in another question, and I realize we're dropping participants, and marketing is telling us we got to keep this like to 30 minutes because people have ADD and no one has patience for long calls, which is fine. And if people need to go, they go. But I think we should go, as long as they're good questions. And I think Jimmy is asking a really good question, which is, you've been through these downturns before within your style of investing. What makes this time different? And I think it's actually a really good question, because we always talk about lessons learned. right? And we always talk how lessons learned are more important than, percentage gains or dollars and cents. And, if you haven't learned anything from a downturn, then you really, missed a big opportunity. And so it's the right question to ask. I'm not sure I have a very clear answer. I can tell you that all of these downturns have differences and they all have similarities. They all had different causes, right? If you think of the great financial crisis, the issue was leverage. And the issue was just free availability of credit and people borrowing with reckless abandon and, cleaning ladies having 9 houses and mortgages. And, what happened was we thought the entire financial system, was on the verge of collapse, right? Now, 2020 was very, very different with global pandemic and COVID. And I think 2020 actually was a problem that it gave us full sense of security. We thought that we learned something from, the dot-com bubble and from the financial crisis, and now we're somehow wiser and that we could protect investors' capital better. And I think, one of the similarities that we're now seeing is all the companies kind of go one way into a crisis, but they come out of it very different. The economy is different when it comes out from a big downturn. And so, to Guy's point, there is an opportunity for a lot of our businesses to use this downturn to their advantage, right? It is not the strongest and it is not the smartest or the wisest that survive. It is those that are most adaptable to change. And so we are looking for these businesses, and we think many of our companies really do exhibit these characteristics, and I think it's really important. So it's not an absentee business. We have to be hands-on, and we have to keep an eye on this, and we have to take actions in accordance to this. But the other thing in terms of lesson learned and similarity, I'm not sure that there's anything that a long-only high growth fund or high growth manager can do to really protect shareholder capital or preserve, value when there is a, broad-based significant downturn like this. After 2020, I kind of thought we could, because we went down a lot less. And I think we mistakenly used that as a barometer of our ability to, outsmart, outthink, the market and everyone else. We are who we are, right? We're high growth investors. And when you have a meaningful style change, I like the way you phrased that question with your style of investing, right? We're high growth investors, at least in global and Fifth Avenue. And when rates go from 0 to 5 in a really short period of time, we're going to get hit, and we're going to get hit hard. And so the only thing that we can do is stay the course, be patient, upgrade the quality of our businesses, and kind of face the music and talk to our shareholders and, be straight and be honest and, and wait it out. That's all I got. Thank you, Frank, for letting me get that in.
Oh, no, thank you very much for doing that. And thank you for everyone for your questions and your comments that I got in the chat box. We appreciate all those. And thank you, Alex and Guy, for taking the time to answer everybody's question. So this concludes today's call. A recording of today's call will be available on our website at baronfunds.com. I want to thank you, Alex and Guy, for your comments once again. And most importantly, I want to thank you all for your support of Baron Funds family. And if you have any additional questions, please contact your Baron contact. Everyone have a great day.